Welkom bij Valuejagers podcast. De podcast over beleggen en goedkope aandelen.
Hello everybody. Welcome to a new podcast from Valuejagers. Today is a very special one with Rick Roel. Let's call him the Charlie Munger of Eric Sprott, the Canadian billionaire in mining companies. He has a great track record, more than 4 decades of experience, if I'm correct. And he was kind enough to join us for a podcast about commodities. And I'm going to start with the $1 million question of today. And that is, why isn't gold moving? We are printing lots of money, but gold is staying at the same level. Do you have an explanation, Rick?
I do. Recency bias. Most people in the world, including most investors and even most value investors, believe themselves to be dispassionate gatherers of facts, meaning that we believe ourselves to be people who take information from all sources rationally, sort that information, and make intelligent decisions based on evidence. But that's not what we do. The truth is that we search the world for information that supports our existing biases and prejudices. And for 40 years, capital markets have taught us that the big thinkers in the world have the economy under control, that interest rates will fall, and that the Fed, through liquidity, will have a put. The other thing about recency bias is that most people's expectation for the future is set by their experience in the immediate rather than the distant past, which is to say that we ignore history and we pay attention to things that we can feel, which releases us, I think, from the obligation that we might otherwise have rationally to think as opposed to feel. What you will find in natural resource markets is that if you explain a thesis to somebody where the outcome is inevitable but maybe not imminent, even though they understand the thesis, they will assume it has no value until the price action of the commodity begins to demonstrate the thesis. In other words, when commodity prices make the thesis less valuable, they become more believable. If you would like evidence of this, look 3 years back in the uranium market. The price of uranium was below $20 a pound. It cost the industry $60 a pound, including cost of capital to make uranium. Either the price had to go up or the lights would go out. Those were the only 2 choices. Any rational observer could understand this, but nobody was interested in buying uranium when the price had to go up. Now that the price of uranium has increased from $20 a pound to $47 a pound. In other words, now that the easy money has been made, everybody is crowding into the uranium space. The precious metal circumstance is the same. People intellectually understand that the debasement of the currency and negative real interest rates are good for gold, but they don't have the courage of their convictions until the move is probably halfway over. If you examine former precious metals bull markets, in particular the 1970 to 1981 bull market, but also the 2000 to 2011 bull market, you will see the same set of circumstances. You will see a lag time between the time when the negative real interest rates on a global basis set the stage for a recovery in gold and silver and the time that they participated. You will also see, sorry for this long-winded answer, you will also see cyclical declines in secular bull markets that were of fairly substantial duration and fairly substantial dimension, which is to say it is not uncommon historically for you to have 12 to 18 months hiatuses and declines in bull markets. These secular declines, cyclical declines, while they're unnerving to participants, are irrelevant in really understanding the bull markets. And I think that the circumstance that we're in now is entirely explainable, understanding recency bias and understanding the nature of cyclical declines in secular bull markets.
Can we then deduct, Rick, that we are at the start there of the turn of the cycle? Then you say, okay, we're maybe the first 1, 2, 3 years and people are not yet believing and they will chase up higher later in the next years?
I think we're coming into the middle of a bull market cycle. In my experience, and I'm not trying to go back 5,000 years, I'm not quite that old, but in my experience, I've been through two prior cyclical bull markets in precious metals, as I've suggested. Both of them, in terms of duration, were decade-long affairs. And in terms of dimension, they were pretty dramatic too. Many people say to me in question and answer sessions, well, Rick, we're 3 or 4 years into a bull market. Is it over? No one can know for sure, but if you examine the fact that the conditions precedent for a bull market are very much intact, and that prior bull markets played out over 10 or 11 years, one would suggest that we are 4 years into what is likely a 10 or 11-year bull market. The dimension is interesting too. Evidence that we're in a bull market has to do with the fact that gold bottomed below $1,000 and now is in the $1,800 range. When people say, when will gold move? My first answer is, 3 years ago, because we've had a very nice move in both the gold and the gold equities. But I think it's important to note, again, when people say, well, gold has moved from 1,000 to 1,800, is that it? In the 1970s bull market, the gold price moved from an admittedly price-controlled $35 an ounce to $850 an ounce, a fairly handsome move. In the 2000 gold bull market, the gold price moved from US dollars $253 to $1,900. Gold has now moved from 1,000 to 1,800, pardon me. If past is prologue, both in terms of duration and dimension, this market has further to go. If that doesn't work, which is to say, if history doesn't work for people, I'd be happy at any point in time in this interview to go through the fundamentals around precious metals and why, in my view, an increase in the price of precious metals is much, much, much more likely than not.
And in what way, Rick, is then in that cycle the current news affecting that thesis that you have? Like say the inflation numbers, the data from China, all these things. How do they influence actually then the precious metal sector?
I think that the answer to that goes two ways. Gold is most commonly priced in US dollars. And the US dollar is strong relative to other fiat currencies, relative to the renminbi, relative to the yuan, relative to the Australian dollar, relative to the euro. The dollar is relatively strong compared to other fiat currencies. My friend Doug Casey describes the US dollar, of course, as the prettiest mare at the slaughterhouse, meaning that relative strength probably won't mean much over the course of the rest of the decade. The second thing is that there is much more broadly based confidence in the system now, because the truth is we've been through 40 pretty benign years. We've been through a period in the sort of 1982 to 2002 timeframe where at least US interest rates have fallen from plus 15 to minus 2, where equity indexes worldwide have gone up tenfold, where we have taken the 2 billion people at the bottom of the economic pyramid in humankind and moved them forward, which is to say, we've been through a very benign 40-year period. There is confidence in the system born of people's experience that I would suggest to you is not borne out as well by the arithmetic of government spending, debt and deficits, and negative real interest rates. I think people's paradigms have been set by living through a very benign period for 40 years. Their expectation of the future has been set by 40 years of benign experience, which I think is causing people to discount the negative impacts of the pressures that have been building, at least for the last 15 of the 40-year period that has been so benign.
If I look then, Rick, in how can we, let's say, normal citizens that don't have the 50 hours a week or 100 that you do a week to monitor this sector, how can we protect our wealth, let's say then in precious metals? Do you advise a mix of physical, let's say, coins and bars? Do you say, okay, have some royalties? I know that you liked that last year as a narrative, but maybe not too expensive. It came down a bit the last 6 months, I would say, the royalty plays. So that's maybe a nice way to add it, or really in the equity, in the producers and the juniors.
I think the first thing that investors have to do is invest in themselves and in their decision-making process. If people don't have the courage of their convictions around the precious metals thesis, they are unlikely to stay the trade in the face of volatility. So the first thing that I would urge the people listening to your podcast to do is examine whether or not they believe my thesis to be true. If they believe, like I believe, that quantitative easing would be more properly known as counterfeiting, then they would understand that quantitative easing debases the currency. If your listeners believe that debt and deficits both consume economic activity from future periods and represent a wealth transfer from younger people earning money to older people who have spent it but forgot to pay for it, then they believe that that debases the currency too. If people believe that a negative real interest rate, such as that which one experiences with the US 10-year Treasury, where the yield is 150 basis points, in a currency where the government acknowledges that the savings, that the purchasing power is declining by 5.5% a year. In other words, if people acknowledge the fact that fiat instrument savings are deteriorating by 400 basis points a year, then I think people come inescapably to the conclusion that conventional savings instruments are perilous. And in those circumstances, over time, precious metals have done very well. People that can't accommodate themselves to that set of facts shouldn't be in the gold space or the silver space, because they will make a purchase, perhaps based on my confidence, but then return to their original paradigm on any weakness in the precious metals price and cause themselves to come out of their investment. To the extent now that people have put themselves through the discipline that I suggested and come to the same conclusion as I would say, yes, of course. First of all, make your precious metals portfolio commensurate with your needs and risks. In other words, don't put 100% of your wealth in precious metals. There is always the chance that we could all be wrong, or that you don't have the confidence to stay the trade. But within that portion that you decide to allocate to precious metals, which will vary, of course, depending on your time preference, your risk allocation, and your need for protection, what you find is that physical precious metals are most properly thought of, at least gold, as an insurance policy. You buy physical precious metals to maintain liquidity because it's extremely liquid in an asset class that does well when other conventional fiat asset classes do poorly. I jokingly tell people that I have fairly large personal inventories of physical precious metals, and I hope they don't go up in price, because any asset class that you hold as an insurance class confronts you with a dilemma. If the price goes up, it means that you needed the insurance, that your risks have gone up. Think about auto insurance. You get paid when you get in a wreck. Life insurance, you get paid when somebody dies. Home insurance, you get paid when there's a fire. Gold is the same. It's fiscal catastrophe insurance. So own it because you need to be insured and hope it doesn't go up in price.
You don't want to live in a $10,000 gold world.
If we have that world, you want to have some, so you'll be okay. But you hope that your thesis is at least not as right as it might become. An investor moves beyond physical precious metals. It becomes not an insurance class, but rather an investment class when you move into the higher quality gold equities, including the royalty companies. And I would urge people who don't have broad experience in precious metals equities markets to overweight the investment grade companies relative to the speculative companies in their portfolios. The reason for this is that the speculators, the people in the juniors, and by the way, I'm one of those, sidebar, all the money that I now invest carefully and prudently, I made by speculating wildly in my youth. So I'm not discouraging speculation. What I'm saying is that in precious metals equities bull markets, simply capturing the market beta, because this market moves so much when it moves, is a very, very, very rewarding circumstance. You don't need to outperform a market that performs as well as the precious metals equity market performs when it performs. So probably 75% of most precious metals equities investors' portfolio should be in high quality precious metals names. The idea that in a bull market you can achieve a triple in Barrick with almost no execution risk within the company is fairly attractive. With the money left over that you choose to outperform the market, then you come down into the juniors. And the juniors are solely a stock picker's game. There are something like 1,500 precious metals focused juniors worldwide. And I would suggest to you that at least 80% of the 1,500 or 1,200 are functionally valueless. It doesn't mean that they won't go up when the precious metals prices go up, but it does suggest that they are absolute capital traps. If you merged every junior resource company in the world into one company, Junior Explorco, that company would lose somewhere between $2 billion and $6 billion a year. One wonders how much you should pay for the right to lose between $2 and $6 billion a year. Should you capitalize this company at 6 times losses, 9 times losses, or if it was in favor, should you capitalize it at 15 times losses? That humor belies, however, the fact that probably 5% of the listed juniors deliver such extraordinary performance that they add legitimacy and even sometimes luster to a sector that loses between $2 and $6 billion a year. So if you come in down into the juniors, and I'm not saying not to, they've been ridiculously good to me, you need to be extraordinarily careful. You have to stay away from narrative. You have to stay away, at least from deposit marginality. You need to work very, very, very hard to allocate money successfully among juniors.
Value for life. Levenslang beleggen in ondergewaardeerde aandelen. U betaalt 1 keer een activatie en ontvangt continu tips en updates. Voor altijd. Ontdek Value for Life via valuejagers.com/value-for-life.
You stole already there a few of my questions there, Rick. I know you're famous from the when not if questions that we have to ask, and I try to do that also in let's say in my due diligence. Can you quickly recap for our listeners what you mean with the when not if questions?
Sure. I would suggest that that's not limited to gold. But if you have a thesis that has to come true, but you don't know when it's going to come true, you are asking yourself a question where the answer necessarily begins with when rather than if. That's a very high quality question. 2 examples of that, one I've given already. 3 years ago, with the price of uranium at $20 a pound and the incentive price for new supply at $60 a pound. In other words, with the industry losing $40 a pound, one of 2 things had to happen. The price of uranium had to go up or the lights had to go out. Those were the only 2 choices. There was no middle ground. Your listeners would have had to ask themselves, which of those 2 probabilities was more likely? Would the price of uranium go up by $40 a pound, or would the lights in the Western world go off? It was very clear that the price of uranium had to clear to the incentive price of production. That was a when question. Nobody knew when it was going to occur. We didn't know when the pace of Japanese restarts would come, but we knew that it had to happen. Similarly, 18 months ago, when, the sort of political combination of the World Economic Forum and Biden and Merkel and COVID artificially depressed the oil price down to $20 US a barrel, it was very clear that the price of oil had to go up or people's cars wouldn't start. Remember, not everybody owns a Tesla. And when you had the oil price at $20 a barrel, with the total fully loaded cost of producing a barrel of oil varying between 50 and 60 US dollars a barrel, it was very obvious that the price of oil had to go up or cars wouldn't start. What do you think would be more likely? Obviously, the market answered the question. The prices went up. That's an example of a when question, not an if question.
Can I challenge you there, Rick, or
Please.
question you on the tin thesis? I've reading for a year now on the tin thesis, and okay, it's been used as solder in ships. We have the shortage there in chips for automotive, but also for technology companies, 5G rollout, and all these things. And the supply is really on the low side. It's never been invested much. It's a really tiny sector. But we saw there in the last year that indeed our thesis came true. It cannot sustain these low prices. Are you following tin? I know you also own Alpha Min
Yes.
in Congo, which is doing great in the last year. But can you comment on tin, for example?
Yeah, I was an active and early Alpha Min shareholder, not solely because of tin, but rather because Bisset looked to me to be a tier one deposit. It looked to me to be a deposit that would generate 40% plus returns on capital employed. That would...
My next question is, Rick, what is a tier one discovery in your definition? But please just continue first on
Fine. It had to be in the bottom decile worldwide in terms of cash cost.
Yeah.
And the Bisset deposit was one where there were three separate resistive structures and where the drill bit had only tested 1/3 of one of three structures. So it was obvious that the deposit could grow. I was also attracted to tin, although I believed, well, let me rephrase that. At the point in time that I made the investments in Alpha Min 3 or 4 years ago, the tin price was so depressed that either the price of tin had to go up or there wouldn't be any solder in the world. And again, I thought, so what are the chances? Either the price of tin goes up or microcircuitry doesn't exist. I think the price of tin is going to go up. The price of tin has gone up. So you need to change your thesis and change your narrative now. You need to go in tin to an if question. If tin continues to deliver utility in microcircuitry and electronics, and if the composition of all of these wonderful new gadgets that the world is enjoying continues at the present rate, then there isn't enough tin. But if you think about tin in its traditional roles, as an agent in solder, as an example, the price of tin now is high enough to justify production. So tin has moved from a when circumstance to an if circumstance. I'm still personally supportive of tin, and I'm still personally supportive of Alpha Min, given that Alpha Min has, with some hiccups, successfully commissioned that mine and is now moving from improving their balance sheet, which they had to do, to drilling out that deposit, which I believe has the potential to be a tier one deposit. Let's do tier one deposits now.
Yes.
$10 billion US or more in recoverable in situ resources at current commodity prices. I have zero interest in small deposits. A tier one deposit has at least $10 billion at current commodity prices in situ reserves and resources that have been defined at least to the indicated and inferred stage. The second criterion for me is that the deposit has to be, at least as a target, in the best quartile worldwide in terms of return on capital employed. In other words, I would like to see a 25% plus return on capital employed at the project level. And the project needs to be in the bottom quartile worldwide in terms of operating cost, post-capital efficiencies. So I want a deposit that wins the last man standing contest. If the price of a commodity falls, I want a tier one deposit to be in the best quartile worldwide in terms of cash cost. And I want it to be in the best quartile worldwide in terms of capital efficiency or return on capital employed. Those are my three theses for a deposit.
Now the trick question there, Rick. We know you are also owner of Adriatic Metals. Would you put that in that level, or is it too small?
Adriatic is too small at present to be a tier one deposit. I believe that ultimately the genesis of Adriatic is related to a volcanic massive sulfide event. There's a lot of dispute around Adriatic as to what type of deposit it is. If I'm right, history teaches us that volcanic massive sulfide deposits occur in clusters. And I am attracted to the exploration upside in Adriatic metals. I'm also certainly attracted to the grade and to the infrastructure. In other words, I'm attracted to the deposit as it is. As it is, it's a tier two deposit. But I think it has the possibility of being a tier one deposit. It will certainly be a tier one deposit, I would suspect, in two of my three criterion, which is to say return on capital employed and operating costs relative to other competitive deposits worldwide, whether or not it meets the first hurdle, which is to say $10 billion in recoverable mineralization at current commodity prices is a different question.
Yeah. And then another, let's say, large discovery in the last months or year even is the Filo del Sol deposit from the Lundins in Argentina, Chile, let's say Argentina. Of course, they still have to drill it out. So, of course, it's not yet certain what you mentioned indicated. But it has all the looks of a generational discovery or not.
This is an if question still. Disclosure of conflicts. I'm way long. I own a lot of it. I go back with the Lundin family to 1975. So I'm on my third generation of Lundin management. This deposit certainly meets the size criterion. This is a monster. And it's a monster that no ifs, ands, or buts is going to get bigger. No ifs, ands, or buts. It isn't just going to get bigger, it's going to get much bigger. And it's related to other deposits controlled by the Lundins in the area. In other words, we aren't talking about a mine, we're talking about a district. We're talking about a camp. The other part of the equation, however, or the other parts of the equation are challenging. The capital costs of building a deposit like this in a remote setting like that are going to be very high. $7 billion, $8 billion. And a lot of the capital is going to have to come in up front. And so developing a net present value that overcomes the upfront capital cost and generating returns on capital employed at the 25% plus range at today's commodity prices is going to be a real challenge. If continued exploration defines a deposit where there is sufficient high grade close enough to surface that the first 3 or 4 years of the deposit can generate above median cash flows and amortize the upfront capital expense, then Filo del Sur could easily become a tier 1 deposit. But understand that the nature of this question is if, not when.
Ontdek een spotgoedkoop aandeel dat steeds populairder wordt dankzij de podcastindustrie. Gratis te downloaden via valuejagers.com/podcast.
They have an oxide cap, but that's maybe not the real goal here. Maybe then to tag on there is for a retail investor, like you mentioned, we have the Lassonde curve that you can almost never escape. When would you say to people, okay, keep your conviction and just wait till Adriatic or whatever company goes through that whole cycle and enjoy the full ride? Or do you say, okay, try to time it, which is very difficult?
Yeah, what I've learned personally, investors need to take stock of themselves because you can tell an investor whatever you want to, but he or she ultimately is going to follow their own lead. For me personally, what I have learned is that great deposits in control of good people are rare, and you have to give them time. When I think back on the real speculative successes that I've enjoyed in my career, that is to say, investments that have generated a minimum of tenfold returns. Tenfold returns commonly take 5 or 6 years to play out. many speculators have trauma holding stock over a long weekend. They need to pay attention to the Lassonde curve. I don't. My own experience too tells me that almost every 1,000% gain that I've ever had, almost every 10 bagger I've ever had, has fallen in price by 50%, one or more times during the period of time that I held it. If you look at the Lassonde curve and you talk about the boring period after perhaps the preliminary economic evaluation, through financing, through permitting, through building, let's say that you experience a 50% decline. I've been fortunate enough to experience probably 50% declines in companies that went on to be 10 baggers. And if you accommodate yourself to the certainty that high quality deposits are rare, and high quality deposits in the hands of good people are rarer, and that when you find a high quality deposit in the hands of a good person, if you want to maximize your gain, forget about trading and think about the fact that it's going to take you 5 or 6 years answering unanswered questions, and that you're going to have to endure a lot of volatility and perhaps a market cycle. Then you're equipped to speculate. If you can't bring yourself around those fundamental truths, you shouldn't speculate at all. You should invest.
All right. Let's shift there. Maybe Rick, we've seen a few or several mergers of equals in the last few years. Yeah. Everybody's hoping for a takeover, and then you get a premium of minus 10% or just a small one. Is that over, the high premiums? And the second question, maybe, how does the mergers of these, let's say now obviously is the big ones, how does that benefit the smaller cap juniors and developers?
Well, first of all, well-constructed merger benefits everybody. In the near term, perhaps the shareholders of the company being acquired get the benefit of the premium. If the merger is accretive to the bigger company, those shareholders benefit too, and probably benefit more, but over a larger period of time. The shareholders ultimately benefit in a well-constructed merger from at least 3 considerations. The first is that the general and administrative expense relative to the assets under management fall. You have one set of G&A covering bigger assets. And general and administrative expense, or at least excess general administrative expense, is a cancer on shareholder value. The second is that in capital markets, there's a preference for larger, more liquid vehicles. And so you have a situation where 2 + 2 can equal 6, because the larger company has more trading liquidity, and as a consequence of more trading liquidity has a higher share price, and hence a lower cost of capital. A lower cost of capital is a huge competitive advantage in a capital-intensive business. The third advantage is that the surviving management team has more opportunity to do capital allocation across a broader set of assets. Having, as an example, 5 development assets in one company allows for a broader range of optimization than having 1 or 2 allocation opportunities through a portfolio. That too often management teams have made production decisions because in the absence of a production decision, their salaries would disappear. It's as simple as that. They had to believe in what they were doing, otherwise they'd become unemployed. And to the extent that a management team has more opportunities through a portfolio, they have a higher probability of making the most economic choice in terms of allocating their shareholders' funds. I believe that the merger and acquisition cycle is just getting underway. I believe we have a circumstance where the mining industry itself has, for the first time in a long been too conservative in terms of capital allocation decisions. The management teams were punished extraordinarily for the bad decisions that they made in the decade between 2000 and 2000. Is that exploration expenditures haven't taken place, development expenditures haven't taken place, mergers and acquisitions haven't taken place. Balance sheets have gotten much, much, much better. Operations are in much better condition. And the consequence of that is that the companies, first of all, need to do acquisitions because they forgot to grow for 10 years. And they're able to do acquisitions because their balance sheets are in such good shape and their free cash flows are in the best shape that they've been in for 50 years.
What's your preference, Rick, in returning, let's say, capital to shareholders? Is that like merger and acquisition or speed up extra projects? Dividends, share buybacks, everything is its plus and minus. What is your preference?
I don't think there's a one-size-fits-all answer. In companies that have exhausted their tax loss carryforwards, probably the most efficient way to return capital to shareholders is share buybacks. Dividends expose you to double taxation. What you hope, of course, is that you are backing a management team that is good at M&A and good at tucking in acquisitions. In other words, reinvesting earned capital at high rates of return, compound internal rates of return, is the best outcome. Finding managers who are competent to do that is a challenge. Often enjoys 60 or 70% operating margins. They're just tremendous generators of wealth. I too believe that the utility of nickel is so high that to the extent that we find nickel, paradoxically, the price can go up. One of the things that is constraining the development of new fabrication techniques for both nickel and cobalt is the fact that the fabricators are concerned about supply. And they're devoting less money to improving technologies around nickel and cobalt than they otherwise would because they're nervous about supply. Separately, in the nickel business, a lot of the nickel that is currently on the market are from nickel laterites in Southeast Asia, which are often, not always, tremendously environmentally destructive, hugely environmentally destructive, and also very, very energy intensive. And so I am attracted to the future of the nickel business, but I'm particularly attracted to the future of the nickel sulfide business, which I think is a much more environmentally and energy sustainable source of nickel than the nickel laterites.
So you definitely know the Tamarack project that's not too far from you in the US.
I do. I personally prefer higher grade projects. You know, the nickel sulfide project in the United States that I obviously like is Eagle, the one that the Lundins have. I have a real fondness for grade. I was brought up in an era where we were taught that tons cost and grade pays. Large, low-grade deposits have, a lot of capital intensity. They have operating leverage, but operating leverage works both ways. I like high-grade deposits, and I like metallurgically simple deposits. When I see a flow sheet that seems to take 2 pages, I run for my life.
That's a good rule of thumb there for beginning investors. All right. Yeah, maybe my last question there, and it's the hardest one I found, is when to sell. When do you sell a position? Is it when you hit the milestones?
I think your sell decision has to vary. I think that when you establish a position, you need to ask yourself why you're establishing the position. And you have to ask yourself right when you establish, either in a positive sense or a negative sense. And I think as your knowledge of the company progresses, that you need to continue to change your milestones. Very simply put, for me, I try to buy assets when they're selling for less than they're worth. That necessitates having an opinion on what something is worth. Most investors don't do that. Most investors follow a thesis called got a hunch, bet a bunch. And so for them, of course, they're going to be troubled by sell decisions. They don't know why they bought it, so they don't know why they're going to sell it. For me, if on a speculation, as an example, I think that there's a 30% chance of a yes answer to an unanswered question. And I've determined what the value of a yes answer is. So I have in my own mind the probability, and I have in my own mind the likely result of the yes answer. I need to ask myself, what's the question that I'll have to ask myself then? If I decide that the third dimension, let's say a drill hole in a deposit that only has a surface expression, strike and width. If I decide that, as an example, a good drill hole will take the price of a 30-cent stock from 30 cents to $1, a few things can happen. One, I can get a drill hole that proves the thesis is wrong. In other words, I can be wrong. And that happens more frequently than not. Yeah. Most people all of a sudden ignore the data. They say, well, I paid 30 cents for it. Now it's selling at 18 cents. I'm going to hold it till it goes back to 30 cents. This is stupid. This is ignoring data. When your reason to own a stock goes away, the stock has to go away. You have to sell it. You can't search the metaverse for something that will allow you in your own mind to forgive you for your existing mistake. The second circumstance is that the drill hole can be successful. And you think it's worth $1 and the stock goes to $1. Well, you've attained your goal. If now you can't form a thesis around the next unanswered question from the data that you got from the last unanswered question, you sell the stock. The third circumstance, and mercifully this has happened to me a lot in my life, you drill a hole, you get back a good data, but the stock doesn't go from 30 cents to $1. It goes from 30 cents to 35 cents or 40 cents. Now you have a circumstance where you have a yes answer. You have in your mind the valuation has been established. In other words, you've already done all the work. Yeah. You get it right and the market gets it wrong. In that case, despite the fact that you haven't had your thesis validated by the market, you buy with both hands.
So you're definitely an advocate for averaging up also, huh? If you say...
If the data is there. Yeah, if the data is there. All of these rules of thumb are ridiculous. They need to be data supported. What everybody looks for is some sort of magic bullet that excuses them from having to do any work. What investing and speculating is about is discounting the probability of future net worth relative to today's price. That's what it's all about. And you're never going to get it right, by the way. The idea is that you get it more right than other people do. To the extent that you're not willing to do the work or do the work to identify somebody who's going to do the work for you, you will be my victim. I will outcompete you in markets because although I don't get it right, I'll get it more right than you. I don't mean you personally, but you understand the nature of the discussion that we're having.
All right. Thanks, Rick. I have plenty more questions maybe for another time.
Well, perhaps I could speak directly to your audience for 60 seconds.
Yes, of course, no problem.
Would that be allowable? I enjoy I enjoy discussions like these, and I like to incent them. Any of your listeners, subscribers, or readers who care what I think about their own portfolios may find out if they would go to a website, ruleinvestmentmedia.com, and enter their natural resource portfolio. Please no crypto. Please no tech stocks. Please no pot stocks. I'll rank that portfolio 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments might have value. In addition, for listeners or subscribers who care about visual representations, I can include a chart of the Barron's Gold Mining Index, the most inclusive equity index I know of going back 60 years, where investors can see for themselves the anatomy of bull markets and bear markets in precious metals and examine the thesis that I put forward early in the interview that we just did. In addition, I'll include another chart that's Goldman Sachs commodity chart going back 100 years that talks about the relative prices of commodities relative to other asset classes in the economy going back 100 years. Ruleinvestmentmedia.com, no obligation. I'll rank your portfolio. If you care about the charts, mention charts in the comment section.
Okay, great. I'll include the link in the podcast. I was going to mention it myself because that's how we got in contact for this podcast, and it's a great way for investors to meet their own portfolio with an expert like you. So I would recommend it to everybody. And thank you very much, Rick, for this great explanation. I think Pete and I have lots of more questions, and we would be glad if you want to join us for another time in a few months or so to see how the commodity cycle goes further from here.
I would enjoy that. You'll know by now that my schedule requires adult supervision, so you can arrange that through Callie, who arranged this one, and I'd be happy for a rematch.
Okay, great to hear. Thank you very much for your precious time, and see you next time.
Thank you.
Okay, goodbye.
Valuejagers podcast. Te beluisteren via de 3 grootste podcastplatformen ter wereld: YouTube, Spotify en iTunes. En vergeet niet om onze gratis aandelentip te downloaden via valuejagers.com/podcast. Het is een spotgoedkoop aandeel dat steeds populairder wordt dankzij de sterk groeiende podcastindustrie.